So, what if I told you that right now, the exact same thing could be for sale at two totally different prices in two different places? I know, it sounds impossible, right? Kind of like a glitch in the Matrix. But this glitch, it's very real. It's called arbitrage. And for a very, very specific kind of trader, it's a gold mine hiding in plain sight.
All right, so here's our game plan for this explainer. We're going to break down what this market glitch is all about and why these price gaps even appear. Then we'll look at the playbook. We'll tear apart the myth of risk-free profit, see why this is a game of pure speed, and finally, get to the beautiful irony of how this whole thing actually helps the market.
Okay, let's start with the big puzzle right at the heart of it all. In our world of instant everything, how on earth can one identical thing have two different price tags at the exact same moment? The basic idea is just incredibly simple. Seriously, check this out. Imagine you see some asset X trading for $100 on one exchange, but at that very same instant, it's going for 105 on another one. The move? You simultaneously buy it for 100 and sell it for 105. Boom. No waiting, no hoping, no guessing what the market will do next. It's just pure profit from a price gap that's already there. And that, in a nutshell, is the official definition. Arbitrage is basically the art of exploiting these teeny tiny price differences across markets. It is a pure mechanical strategy. It doesn't rely on predicting the future. It relies on what the price is right now. But this just brings up a huge question, doesn't it? I mean, if markets are supposed to be these perfect, efficient machines, these gaps shouldn't exist in the first place. So why do they? What's causing these cracks in the system? We're told all the time that prices reflect all available information, instantly. So where's the disconnect here? Well, here's the thing. The word instantly isn't really instant. There are a few key reasons for these gaps. You've got some exchanges that are just plain faster than others. Then there's geography. Stuff like taxes or regulations in different countries can mess with prices. But, and this is the big one, information itself doesn't hit everywhere at once. A delay of just a few milliseconds, for the right person, that's a massive window of opportunity. So now that we know why these gaps pop up, let's get into the different strategies traders use to actually pounce on them. Because it's not always just about buying and selling the same stock on two exchanges. It gets more creative than that. Now, there are a whole bunch of variations, but three big ones you'll hear about are spatial arbitrage, which is the classic example we've been talking about, triangular arbitrage, which is a whole other level of cool that happens in currency markets, and then there's risk or merger arbitrage, which is all about betting on whether a big corporate deal will actually go through. Let's quickly unpack that triangular one, because it sounds way more complicated than it is. Imagine the exchange rates between, say, the US dollar, the euro, and the Japanese yen are just a little bit out of sync. A trader can start with dollars, flip them into euros, immediately flip those euros into yen, and then finally turn that yen right back into dollars. If the rates were even a tiny bit off, they can end up with more money than they started with, all in a few lightning-fast clicks.
Okay, so this all sounds like a cheat code for the market, right? Like a license to just print money. It's often called risk-free profit. But now we're going to peel that shiny label back and look at the real dangers lurking underneath.
You know, it's such a seductive phrase, isn't it? Risk-free profit. It suggests a guarantee, something that basically doesn't exist anywhere else in the world of finance. So let's get real. Is it truly risk-free? You know, in some perfect, theoretical, academic world, maybe. But out here, in the real world, no way, not even close. The real-world risks are huge. The absolute biggest one is called execution risk. That's when by the time your buy order actually goes through, the price on the other end has already changed and poof, the gap is gone. Then you've got transaction fees, which can literally eat your entire profit. There might not be enough of the asset to buy or sell. And oh man, transfer delays, especially in something like crypto, can take minutes, and in this game, minutes are an eternity. And all of this brings us to a really critical point. If there are all these risks and the gaps are super tiny and only last for a split second, who is actually winning this game? Well, the answer is simple. It's the fastest players, and only the fastest. Look at this matchup. It's not even a fair fight. You've got high-frequency trading firms operating in microseconds, paying practically nothing in fees, using servers that are physically located right next to the exchange's computers. On the other side, you've got a regular person working in seconds over their home internet, paying standard fees. This is like putting a go-kart up against a Formula One race car. So let me just give you the hard truth. By the time you or I could ever possibly see one of these price gaps on a screen, an army of automated algorithms has already seen it, traded it, and closed that gap completely. For us, that opportunity is already ancient history. Okay, so if this is a game that we can't play, why should we even care about it? Well, this is where the story gets really, really interesting. It leads us to the final and maybe the most fascinating part, the beautiful irony of what arbitrage actually does for the entire market. Just think about what these traders are actually doing. They are, for all intents and purposes, predators. They are actively hunting for flaws, for those little moments when the market isn't working perfectly, for those tiny cracks in the system. And here it is, the punchline. By exploiting these little mistakes, they fix them. When they buy the cheaper asset, they drive its price up. When they sell the more expensive one, they push its price down. The very act of grabbing that profit forces the two prices back together. So this activity that looks kind of parasitic on the surface, it's actually the market's own immune system. It ensures the law of one price holds true, which makes the whole market more efficient and fair for the rest of us. It keeps prices honest. It's wild, right? The hunters of inefficiency are the very ones who create efficiency. And all of this leaves us with one last thing to think about. Arbitrage always adapts. As our technology gets better and closes the simple gaps we see today, new, more complex ones are going to pop up. As our financial systems get faster and smarter, the question isn't if there will be glitches, it's what will they look like and who's going to be fast enough